Here are moments in financial history when one number quietly appears on a government report and almost nobody notices. No emergency press conference, no market circuit breakers, no dramatic announcement from the White House, just a single line in a Treasury report. And yet, that one number can reveal far more about the future of America's financial system than the headlines dominating television. This is one of those moments. Because while millions of investors were watching stock prices, while economists debated inflation, and while the media focused on politics, one of America's closest allies was doing something that deserves far more attention. Japan reduced its holdings of U.S. Treasury securities by roughly $66 billion. At first, that sounds like another technical statistic, just another movement inside the world's largest bond market. But it isn't. Because when one of the largest foreign holders of U.S. government debt begins reducing its position, the question isn't simply, what happened? The real question is, what does it mean? Ladies and gentlemen, that is the story almost nobody is asking. And if you own gold, silver, or simply care about protecting your savings, this story may matter far more than today's stock market headline. Because this isn't really a story about Japan, it's a story about confidence. Confidence in government debt, confidence in interest rates, confidence in the US dollar. And history teaches us that confidence is one of the most valuable and fragile assets any financial system possesses. Now, before we go any further, let's clear up one misunderstanding. Many people hear that Japan sold tens of billions of dollars in US Treasury bonds and immediately imagine panic. They picture governments dumping American debt overnight. They imagine a financial crisis beginning the next morning. That isn't how Treasury markets work. The U.S. Treasury market is the deepest and most liquid bond market on Earth. Trillions of dollars change hands every single day. Large transactions happen constantly. Institutional investors rebalance portfolios. Central banks manage foreign reserves. Governments adjust currency exposure. None of that automatically signals a crisis. So if that's true, why is everyone talking about Japan? Because context changes everything. Imagine you're watching the captain of a massive cargo ship make a slight adjustment to the steering wheel. The movement itself is small, but if you know the ship has sailed the same course for years, that tiny adjustment suddenly becomes much more interesting. Japan has long been one of America's largest foreign creditors. For decades, it has held enormous amounts of U.S. Treasury securities as part of its foreign exchange reserves. These holdings have helped stabilize financial relationships between the world's largest and third largest economies. So when those holdings begin changing meaningfully, professional investors pay attention. Not because they believe catastrophe is guaranteed, but because they understand something ordinary investors often overlook. Big money rarely speaks through headlines. It speaks through positioning. And positioning usually changes before narratives do. Now here's where the story becomes even more fascinating. Many people assume Treasury bonds are simply loans. The U.S. government borrows money, investors receive interest, end of story. But Treasury bonds are much more than that. They are the foundation upon which much of the global financial system is built. Banks hold them, insurance companies hold them, retirement funds own them, central banks store them as reserve assets. They influence mortgage rates, business borrowing costs, corporate financing, and countless financial products around the world. In many ways, Treasury securities are the plumbing behind modern finance. Most people never see the pipes, but everyone notices when the water stops flowing properly. That is why changes inside the Treasury market deserve attention. Not because they create immediate drama, but because they quietly influence almost everything else. Now let me ask you something. If one of the largest holders of U.S. government debt reduces its position, who buys those bonds? That question is far more important than the sale itself. Sometimes other governments buy them. Sometimes pension funds step in. Sometimes banks increase their holdings. Sometimes private investors see attractive yields. And sometimes the market demands higher interest rates before enough buyers appear. That final possibility is where gold and silver investors begin paying attention. Because higher Treasury yields can influence nearly every major financial asset. Now let's bring another piece into the puzzle. Politics. Whether you support President Trump or disagree with him is not the important question here. Markets don't vote. Markets calculate. Investors examine policy, tax plans, tariffs, government spending, budget deficits. economic growth, inflation expectations. Every one of these influences the Treasury market. If investors believe future government borrowing will increase substantially, they begin asking another question. Who will finance all that debt? That question has become increasingly important as government borrowing has expanded over the past decade. Every new Treasury auction depends on willing buyers, domestic investors, foreign governments, banks, investment funds, insurance companies. The demand for U.S. debt remains one of the most closely watched indicators in global finance. Now consider this. Imagine you're attending an auction for a valuable piece of artwork. If dozens of buyers compete aggressively, the price rises. If fewer buyers appear, the seller may need to lower the price to attract interest. Bond markets work in a similar way. When demand weakens, yields often move higher to attract additional buyers. And those higher yields ripple throughout the financial system. Mortgage costs, corporate borrowing, consumer loans, business investment, even precious metals. Everything begins adjusting. That is why experienced investors rarely view Treasury markets in isolation. They understand every financial market is connected. Stocks, bonds, currencies, gold, silver, oil, the dollar, none exist independently. Pull one thread, and eventually the entire financial fabric begins moving. Now here's what makes this moment especially interesting. While headlines focus on politics, professional investors are quietly watching something much deeper. They are asking whether foreign demand for U.S. Treasuries is changing over time, not 1 month, not 1 quarter, years, because trends matter more than isolated events. One sale doesn't define a decade, but repeated changes can slowly reshape market expectations. That is exactly why experienced institutional investors spend so much time studying capital flows instead of simply watching television. Money leaves clues long before headlines explain them. And that brings us to perhaps the biggest misunderstanding of all. Most investors believe markets react after important news becomes public. In reality, markets often begin adjusting while everyone else is still debating the headlines. Large institutions monitor government borrowing, central bank reserve allocations, Treasury auctions, currency movements, interest rate expectations, global capital flows, thousands of individual data points. By the time ordinary investors hear one dramatic headline, professional money has often been analyzing the underlying trend for months. That doesn't mean institutions always know the future. Far from it. But they understand one timeless principle. The biggest financial stories rarely begin with panic. They begin quietly, with small shifts that gradually become impossible to ignore. So don't think of Japan's Treasury reduction as the entire story. Think of it as the opening chapter, a signal encouraging investors to ask better questions. Who is buying America's growing debt? What happens if borrowing continues rising? How will higher bond yields influence the economy? And perhaps most importantly, what happens to gold, silver, and the US dollar if confidence in government debt begins changing over the years ahead? Because once we begin answering those questions, we move beyond politics, beyond headlines, and into the deeper forces that shape every major financial cycle. And that deeper story is where we're going next. Now let's move beyond the headlines entirely, because Japan's Treasury sale is only one piece of a much larger puzzle. To understand why professional investors are paying such close attention, you have to understand the challenge sitting at the center of America's financial system. Debt. Not next year's debt, not next quarter's borrowing. The accumulated debt that has been growing for decades. Every year, the United States finances government operations by issuing Treasury securities. Investors around the world purchase those securities, lending money to the U.S. government in exchange for interest payments and the expectation that they will be repaid. For generations, this system has worked remarkably well. The United States built the deepest and most trusted bond market in history. Treasuries became the world's benchmark safe asset. Banks held them, central banks accumulated them, pension funds relied on them, insurance companies built portfolios around them, and during times of financial panic, global investors often rushed into U.S. government debt rather than away from it. That confidence became one of America's greatest financial strengths, but confidence is not permanent. It has to be earned continuously. Every Treasury auction asks the same simple question: who wants to lend America more money? As long as demand remains strong, borrowing remains relatively smooth. But if investors begin demanding higher compensation before lending, everything changes. That compensation is called yield. And yield, quietly influences nearly every corner of the economy. Think of Treasury yields as gravity. You can't always see gravity, but everything responds to it. Mortgage rates, corporate borrowing, credit card interest, auto loans, business investment, stock valuations, even the price of gold and silver. When Treasury yields rise, the financial landscape changes. Money becomes more expensive. Businesses think twice before borrowing. Consumers become more cautious. Investors begin reassessing risk. That is why professional money watches the bond market with such intensity, because the bond market often speaks before the stock market does. Now let's connect this to government policy. Every administration, Republican or Democrat, faces the same challenge. How do you encourage economic growth while managing government finances? Different leaders propose different solutions. Some prioritize tax reductions. Others increase public investment. Some expand spending. Others emphasize spending restraint. Markets don't judge these ideas politically. They judge them mathematically. If investors believe government borrowing will increase substantially over time, they naturally begin asking whether future Treasury issuance will also increase. More borrowing generally means more bonds entering the market. And whenever supply grows, another question immediately follows. Will demand grow just as quickly? That question matters far more than most people realize. Imagine a farmer bringing twice as much wheat to market next year. If buyers increase at the same pace, prices may remain stable. But if supply grows faster than demand, prices often adjust until new buyers appear. Bond markets operate under the same principle. When larger amounts of debt need financing, investors closely monitor whether demand remains strong enough to absorb it smoothly. If demand weakens, yields may rise to attract additional capital. Now think back to Japan. This is why professional investors viewed Japan's Treasury reduction as noteworthy. Not because one transaction changes the entire market, but because every major holder influences the balance between supply and demand. If one large buyer steps back, someone else must eventually step forward. The market continuously searches for equilibrium. Sometimes domestic investors provide that demand. Sometimes pension funds do. Sometimes money market funds increase purchases. Sometimes international investors return. And sometimes yields rise until enough buyers decide the opportunity has become attractive. That adjustment process is one of the most important mechanisms in global finance. Now here's something that rarely makes headlines. Large institutions don't make decisions based on emotions. They operate using probabilities. A pension fund managing hundreds of billions of dollars isn't asking, will tomorrow be a good day for bonds? Instead, it's asking, what is the probability that yields move higher over the next year? What is the probability inflation remains elevated? What is the probability economic growth slows? Every investment becomes a probability exercise, and probabilities change as new information arrives. Government borrowing, inflation, employment, economic growth, treasury auctions, foreign demand, central bank policy. Every new data point slightly shifts institutional expectations. That is why markets sometimes appear disconnected from the news. While television debates one political headline, institutional investors are recalculating thousands of probabilities behind the scenes. Now let's consider another important layer. Suppose markets begin believing government deficits will remain elevated for many years. That doesn't automatically create a crisis, but it can gradually influence expectations about future Treasury issuance. Those expectations can influence yields. Higher yields can tighten financial conditions. Tighter financial conditions can slow economic activity. Slower growth may eventually change expectations for Federal Reserve policy. Notice what just happened. One issue quietly affected another, then another, then another. Financial markets are not isolated events. They are connected systems. Every decision sends ripples through the next. Now let's bring gold and silver into the discussion. Many investors assume precious metals move only because of inflation. Reality is much more complex. Gold constantly competes with interest-bearing assets. When Treasury yields rise significantly, some investors find government bonds increasingly attractive. Capital shifts. Gold can experience pressure. But there is another side to that story. If rising government borrowing eventually creates concerns about long-term fiscal sustainability, or if investors begin questioning future purchasing power, gold often re-enters the conversation for an entirely different reason. Not because it produces income, but but because many investors view it as a long-term store of value during periods of uncertainty. This is why precious metals often behave differently across different stages of economic cycles. Sometimes yields dominate, sometimes inflation dominates, sometimes financial stability becomes the larger concern. Understanding which force is strongest at any given moment is far more valuable than reacting to individual headlines. Now, here's where markets may be underestimating the risk. Not necessarily the risk of immediate collapse. Financial systems rarely unravel overnight. The greater risk is complacency. History shows that major financial shifts often begin quietly. Debt grows gradually. Borrowing costs rise slowly. Foreign demand changes one allocation at a time. Treasury auctions remain successful until investors begin asking more difficult questions. That transition rarely announces itself with one dramatic event. Instead, it unfolds over months, sometimes years. Professional investors understand this. They don't wait for certainty, they prepare for possibilities. They constantly monitor whether the underlying trends are becoming stronger or weaker. That is exactly why bond markets deserve far more attention than they receive, because while headlines focus on elections, campaign speeches, or daily political debates, institutional capital continues flowing according to mathematics, incentives, and long-term expectations. Money doesn't care about political slogans. Money follows risk. Money follows return. Money follows confidence. And confidence can shift long before headlines acknowledge it. That is why Japan's Treasury reduction matters. Not because it predicts the future, but because it reminds us to watch the deeper forces beneath the surface. The real question isn't whether one country reduced its holdings. The real question is whether global demand for U.S. debt remains strong enough to finance an era of expanding borrowing without requiring meaningfully higher yields. Because if that balance changes, it won't just affect Treasury markets, it will influence the dollar, interest rates, stock valuations, real estate, and perhaps most importantly for long-term investors, the future role of gold and silver in protecting wealth. And history suggests that when confidence, debt, and monetary policy begin colliding at the same time, the most important chapter is usually still ahead. Now we've reached the deepest part of this story, because if you only focus on Japan's Treasury sale, or only on President Trump's economic agenda, or only on today's bond yields, you risk missing the lesson that history has been trying to teach investors for generations. Markets change, governments change, presidents change, central bank leaders come and go, but financial cycles continue, and they almost always follow the same pattern. Periods of confidence encourage borrowing, borrowing expands, debt grows larger. Eventually, markets begin asking whether that debt can continue growing at the same pace. That question doesn't always create panic. Sometimes it creates years of gradual adjustment. Sometimes it creates sudden moments of volatility, but eventually, it always demands an answer. History gives us several reminders. In the late 1970s, inflation surged, bond markets struggled to find stability, and confidence in the purchasing power of the dollar weakened. Gold experienced extraordinary gains, but the journey was anything but smooth. Investors endured sharp corrections, frightening headlines, and periods when many believed the rally was over. Then came the early 1980s. Interest rates climbed dramatically as policymakers worked to restore confidence in the financial system. Gold corrected sharply. Bond markets eventually stabilized. The lesson wasn't that one asset always wins. The lesson was that every cycle rewards investors who understand the bigger picture instead of reacting emotionally to every headline. More recently, during the global financial crisis of 2008, fear spread through markets with incredible speed. Investors questioned banks, credit markets froze, governments responded with extraordinary measures, central banks cut interest rates and introduced massive liquidity programs. Once again, the financial landscape changed almost overnight. And then came another reminder in the years that followed. Global debt continued growing, central banks accumulated more assets, governments borrowed on an unprecedented scale. Each crisis was different, but the underlying theme remained surprisingly familiar. When uncertainty rises, investors begin searching for assets they believe can preserve value. That brings us to today. No one knows exactly how this story ends. Anyone claiming certainty about the next year is making a promise that financial markets have never allowed anyone to keep. But we can think in scenarios, not predictions. Scenarios. The first scenario is the stability scenario. Japan's Treasury reduction proves to be part of routine reserve management. Demand from other investors remains strong. Treasury auctions continue functioning smoothly. Economic growth remains resilient. Inflation gradually moderates. Bond yields stabilize. Markets continue adapting without major disruption. In that environment, gold and silver may experience periods of volatility, but the broader financial system continues operating much as it has for years. The second scenario is the adjustment scenario. Government borrowing remains elevated. Foreign demand evolves slowly. Investors begin requiring slightly higher yields to absorb increasing Treasury issuance. Borrowing costs drift upward across the economy. Growth slows modestly. Financial markets become more selective. Volatility increases. Gold and silver could benefit during periods when investors seek diversification against uncertainty, even as higher yields occasionally create short-term pressure. Then there is the third scenario, the one markets often underestimate. Confidence changes more quickly than expected, not because of one headline, not because of one country, but because multiple forces begin reinforcing each other at the same time. Persistent deficits, higher refinancing costs, changing global capital flows, unexpected geopolitical events, slower economic growth. When several pressures arrive together, markets can move much faster than anyone anticipated only months earlier. Again, this is not a prediction, it is a reminder. Financial history is filled with events that seemed impossible until they happen. Now let's bring this back to the investor sitting at home. Perhaps that's you. You don't control Treasury auctions. You don't decide fiscal policy. You don't determine how much debt governments issue. You don't influence central bank reserve decisions. What you do control is your reaction. That may sound simple, but investor psychology has always been one of the greatest advantages or greatest liabilities in wealth preservation. Think about what usually happens during periods of uncertainty. The headlines become louder. Predictions become more extreme. Fear spreads faster than facts. People begin making decisions based on emotion rather than understanding. History suggests that this is precisely when discipline becomes most valuable. The investors who consistently protect wealth over decades are rarely the ones who predict every market move correctly. They are the ones who avoid emotional mistakes. They remain curious. They stay informed. They ask deeper questions. Instead of asking, "Should I panic today?" they ask, "What has fundamentally changed?" That single question separates reaction from analysis. If Japan reduces Treasury holdings, what does it actually mean? If bond yields rise, why are they rising? If gold falls, is it because long-term fundamentals changed or because short-term expectations shifted? If markets rally, is confidence improving or are investors simply responding to temporary news? The people who ask better questions often make better long-term decisions. Now consider one final image. Imagine standing on a rocky coastline during a storm. The waves crash violently against the shore. Some are enormous. Some disappear almost immediately. If you focus only on the individual waves, everything feels chaotic. But if you step back, you notice the tide. The tide moves much more slowly, yet over time, it changes everything. Financial headlines are waves. Political debates are waves. Treasury auctions are waves. Inflation reports are waves. The deeper forces, government borrowing, long-term confidence, productivity, demographics, and monetary policy, are the tide. Successful investors learn to watch both. They respect today's headlines, but they never allow headlines to blind them to long-term trends. That is why this story isn't really about Japan, and it isn't only about President Trump. It isn't even only about Treasury bonds. It's about understanding how confidence moves through the financial system, because confidence influences capital. Capital influences interest rates. Interest rates influence borrowing. Borrowing influences growth. And eventually, every one of those forces influences the assets people choose to protect their wealth. If today's discussion helped you see that bigger picture, I'd genuinely like to hear your perspective. Do you believe Japan's Treasury reduction is simply routine portfolio management? Or do you think it reflects a broader shift that investors should watch more closely over the coming years? And one more question. If you had to choose the single biggest long-term risk to the U.S. economy, what would it be? Persistent government debt? Higher interest rates? Inflation? Or something entirely different? Share your thoughts in the comments below. Some of the best conversations happen when experienced investors challenge each other's ideas respectfully, and those discussions often add more value than the headlines themselves. If you enjoy documentary-style analysis that goes beyond politics and explores the deeper forces shaping gold, silver, bonds, and the global economy, subscribe before you leave. Because the biggest financial stories rarely begin with breaking news. They begin quietly, hidden inside Treasury reports, bond auctions, capital flows, and the small signals that most of the world overlooks. By the time those signals become front-page headlines, the smart money has usually been watching them for a very long time. And now, so have you.